Let's invite into this conversation on PNB, the collateral impact on the banking sector and the banking industry, Dhananjay Sinha, Head of Research at Emkay Global. Hi, good morning, Dhananjay.
Good morning.
A quick question first on PNB and what you make of what's gone on. The question we were trying to ascertain with Sajid is, does Nirav Modi's empire have 6,000 crores to pay back, as seems to be the promise that he made? Anybody's guess to judge, but more importantly, what's the impact going to be on PNB as a result of what we've heard over the last 48 hours?
So I think, how it will pan out, what the regulators do, how much you can actually take back from the organization, that's a separate thing. But assuming that the numbers are what it is, there is a likelihood of a hit in terms of the capital that the bank has. So the tier 1 capital gets eroded considerably. I would say roughly about 1/5 of the tier 1 capital gets eroded. In terms of the ratio, it comes down by 260 basis points. So effectively, in terms of valuation, the stock, the stock price looked very expensive because of the sudden reduction in the tier 1. The important thing to really look at is even after considering that that entire hit, I think roughly about 13,000 crores is what we are estimating. There is a hit on the price, on the book value of roughly about 56 rupees. So that's a pretty good.
Why 13,000 crores? Sorry if I may interrupt you.
So, I mean, that's what our analysis is in terms of, I think what the entire amount is about 11,000.
11,000 plus 1,700 funded credit. So I think that's what everybody is doing.
So that the entire thing is roughly about 13,000 crores. So the point is, if you take, that makes the capital very vulnerable. So even if you consider what was being recapitalized as 5,400 odd crores in terms of recapitalization bond, all that goes away. And you still have a hole in the book. Okay. So essentially, the ability of the banks to grow going forward will be compromised. So that's one implication.
Dhananjay, so I mean, how does again, sorry to interrupt. What is the right way to compare this? So this will first come into provisions. Is that how it starts?
So yeah, I think it should be considered within the provisioning, right? It should be, because that becomes a straightaway bad asset, right? So
yeah.
it has to be written off. It has to be written off. See, we don't know how much can be plowed back. So if you look at the status as of now, it should be considered as a complete NPA, and it should be completely provided for.
It would be an NPA on the books of the other banks, no? The ones who have lent based on this LOU.
No, because they have a guarantee from another bank, right? Which
yeah, so that's
not a guarantee from a corporation or an individual. It's a guarantee from another bank.
So for them, it will not be an NPA, like the union banks, etc. For them, it will not be an NPA, but for this, for PNB, it will be an NPA.
So whatever be the amount, that consideration has to be written off from the book. So according to us, that reduces the tier 1 capital by almost like 25%. And that's a major hit. So effectively, the stock becomes expensive. You are not able to grow. I think the broader issue is about a systemic issue, whether, this is a one-off or there are more such transactions. So in terms of the way the regulators will actually respond is to actually ring fence it, prevent it from becoming a contagion.
Yeah.
But the bigger issue is about the monitoring system, these issues being, unattended, or, it was not really identified in a system where you have a more technology-based MIS, etc. So those are the things that come into consideration as far as future outlook is concerned. So I think that is an uncertain part of the whole story.
Does it just add to all the negativity around PSU banks in general? And I was, we were joking that we didn't even get time to absorb the new stressed asset circular and the impact of that, and then this came in.
Yes.
But just the negativity around PSU banks.
Yeah, so we have been, I have been underweight PSU banks for donkey's years, almost like 7 years. I see the key issue is, bank managements have been talking about the fact that NPAs have actually peaked out for a long time. You've seen that, but consistently that has actually grown. The thing is, now you have the RBI guidelines on the restructured asset. Incrementally, it would mean that the option for banks to actually classify bad assets into restructured asset incrementally will go away, and hence you have to provide for it on a higher basis. So GNPA growth happens at a higher pace. So in recent quarters we saw that the GNPA growth has actually started to taper off. That will start increasing.
Again, yeah.
The other aspect is the existing stock of restructured asset, roughly about 2.6 trillion rupees or thereabout, 2.5 trillion rupees. How that rolls out going forward. So are there slippages coming from there also? So what is classified as standard asset within the restructured asset also starts sort of adding to the pipeline. So we don't know how much will that be, but clearly the shock is on the positive side as far as GNPA growth is concerned.
Upside,
and on top of that, this is what it is. The third angle, of course, is the fact that post the demonetization, all the banks had actually, especially the PSU banks, had gone overboard in terms of the GSEC exposure and increased. Yeah. And my hunch is that they actually increased duration in their GSEC portfolio to gain from the trading profits. So if you look at past 6 quarters, excluding the December one, roughly about more than 100% of the total profit before taxes were actually contributed by trading profit. So with the yield curve actually steepening, you have a significant hit in terms of the trading losses. So your ability to grow is not there, is compromised, and some of these developments actually add to that woes. And you have credit cost rising, and you have trading profit, which is on the other side. So clearly, from a structural standpoint, even cyclical standpoint, ability for the PSU banks to actually grow or regain market share is severely compromised, according to me. And hence, I think whatever cyclical recovery that we are expecting from a credit growth standpoint largely will be taken over by private lenders.
Private banks again.
So that's how I look at things, yeah.
And actually, that brings into the question this whole debate about whether NBFCs will have a really tough time in 2018 because that space is still vacant. NBFCs, even though they may have to bear with the rising cost curve, will still have the market open to gain more market share for the PSU banks.
Absolutely,
right?
yes.
So that thesis continues.
So you're right. So the thing is that the question for the for the NBFC space is about the valuation. So the ability for them to grow is not really compromised. I think the ability to grow with a higher margin is somewhat compromised, because what we have seen with respect to NBFC over last several quarters, I think couple of years also, when the yields were actually falling, rates were lowering, they all went, they increased the duration, the exposure to short-term liabilities, and hence showed significant margins, and hence ROAs, and hence the valuation. So I think as far as growth is concerned, they might still be structurally on a positive side, but from a cyclical standpoint, their margins might squeeze, ROAs might get compromised. But I think that's only a valuation thing. So at some point of time, they will again become attractive. Yeah.
Just very last question. So you said you've already been negative on public sector banks. Are you segregating within that? I mean, one assumes that some public sector banks have to grow and continue to be strong. Maybe the SBIs of the lot. I just want to point out before Dhananjay answers the question that in the last 2 weeks, we've just seen SBI knock us off with a loss, and we've seen the second largest bank in the country knock us off with a fraud. So what is to segregate if the top 2 banks in the PSU sector? I'm not sure what my comeback to that is, but I just cannot understand how 70% of the banking market can be written off. I mean, they are still 70%. Nobody's writing them off. Not of incremental. Invest further money in it. I think that's
absolutely.
The point,
so the thing is that the issue for the PSU banks is whether they can I have told all the dynamic aspects. Now the whole issue is about whether the headwinds that they face, are there opportunities where they can actually grow stronger than the system, grow more profitably incrementally, so that all these headwinds that they have are neutralized? My answer is no. See, my answer is no. So clearly, if you look at the larger banks, as Menika was saying, they are still showing that stress. So I think over the next 2-3 quarters, with higher provisioning, higher GNPA growth, I think the sentiment is still not really turning positive for them. And if you notice, what is really happening within the banking space is that some of the private lenders have actually improved in terms of the growth capital. So if you look at ICICI Bank or Axis Bank, they have raised money either by selling stakes in subsidiaries or raised money. If you look at HDFC Bank, they have also talked about raising money. Notwithstanding, HDFC Bank already had growth capital. On top of that, they are growing capital. So if you look at even the corporate lenders such as ICICI Bank and Axis Bank, if I knock off 75% of their stressed asset, including the restructured asset, they still had the growth capital, and incrementally whatever they have done with respect to raising capital, that only adds to the potential to grow. So if you look at it, it is very clearly visible in terms of who is going to gain market share. And if you look at it, the whole mix of the lending that banks are doing, more inclined towards retail lending, less towards corporate. Also with respect to what banks are doing with respect to their deposits, especially the private lenders, they have actually increased the CASA and also the retail deposit of the total pie of the total deposit. I think they are all in a scenario where they will gain market share, and especially those who are actually having good ALM. In a rising rate scenario, they will actually gain margin. So I think the whole contour of the banking space is very clearly visible.
Okay, I have one last question, and I think it's both equally, Dhananjay, to you as to Ira. I think when the government last announced its recapitalization program, and people were a little pleasantly surprised that it turned out to be bigger than anticipated. But today, when you look at the situation with both SBI and PNB, you got to wonder whether even that amount is good enough or not. And so I'm just, at this point in time, are we at all talking about the government needing to step up its contribution to bank capital even more than what they announced? 2.1 lakh crores is what the total program was, right? But these top two banks are showing holes much bigger than anticipated.
But SBI has capital. SBI does not have a capital.
So therefore I'm asking, does it mean that we're going to, is the next big thing will be to go back to knock at the door of the government and say, you're going to have to cough up more capital, otherwise you're going to see a shrinking size of the PSU bank industry?
Correct. I think we have done this analysis on an aggregate basis, and I'll talk about SBI also a little bit. So we looked at that 2.1 trillion, recapitalization thing that is there. I think our estimate in terms of the GNPA this is written somewhere around November. So 7 trillion rupees worth of GNPA and restructured asset of about 2.6. So roughly about 9.6 trillion rupees worth of stressed assets. So there is 45% provisioning that you have done on average for all the PSU banks. They have provided 45% on the GNPA. So you have an unaddressed or unprovided GNPA of roughly about 6.5 lakh crores, right? Yeah. So if you look at that, and then we look at, we have taken a haircut of 75% of the total outstanding stressed assets. So if you look at it, people said that it is very aggressive. You should be somewhere around 50%. And if as the things are turning around, example is PNB, that 75% haircut was a fair level of haircut. So if you look at that and say that there is what is a tangible tier 1 and what you need to have with respect to the required level of 9.5% tier 1 capital, we arrived at a number saying that 2.1 trillion rupees that has been provided as recapitalization is falling short by 2.6 trillion rupees. So
it's
clearly
50% of what is required or less.
So yes. So my analyst also said that if you take into consideration this haircut and then write off the 75% haircut, then you have an ability to grow going forward and hence plow back some earnings from future. And hence, if you consider that, then possibly it is adequate. But if you look at the PNB example, is when you take additional, you knock off 25% of your book, then your asking rate is even higher. So I'm saying that even 2.6 trillion worth of shortfall that I'm saying looks to be realistic, right? 2.1 is definitely inadequate.
So you're saying that the recap should have been somewhere in the size of 4.7 trillion?
Yes, 4.7. Yes, exactly.
If the government or the owner or the shareholders want public sector banks to be able to continue to grow their books and either maintain or grow market share in this
Correct.
Business, right?
So at with the numbers that I've just talked about, you get the statutory requirement of 9.5% of the tier 1.
Got it.
See, even at that level, if you look at other banks, right, they will be much higher. So while with 9.5% you will be able to do a normal growth, it is important is that which are the
it's not as
which
good,
systemically who is growing faster.
Got it.
And according to me, and my view is that when I wrote this, that over the next 2 years, these PSU banks will still be grappling with the NPA issues and resolution issues and all these things.
Certainly
and there are other guys who already have growth capital, right? So if I have to put my money, I know where to put my money. So I need to be with lenders who can gain market share.
Yeah, well, that's interesting numbers and great analysis.
Yeah.
Thank you so much, Dhananjay.